When you compare what buyers are spending before and after rates spiked, in 2 of the 3 worst instances, buyers are actually spending more per month now than they would have had they bought with a low fixed rate mortgage when prices were at their peak. If you browse the Toronto real estate section of Reddit, Twitter, or Toronto Life, you'll come across plenty of nightmare scenarios where buyers bought a property when prices peaked and are now forced to sell, in many cases at a significant loss since buying, some selling as low as 30% below what they had bought for. It really is a nightmare scenario for a homeowner. These sales are most likely due to the sellers being on a variable rate mortgage rather than opting for a fixed rate mortgage when they had purchased, or being financed with an alternative lender like a private mortgage. Some of the media outlets have talked of a market correction, and to be fair, this past fall was extremely slow. And in December, the market felt like it could actually move towards a long-term correction. But from what I've been seeing the first 4 weeks of January 2023, Toronto real estate has actually performed surprisingly well since the new year. So all of this got me curious to see the mortgage payment numbers and whether buyers are better off now that prices have fallen, or if they would actually have been better off if they purchased at a higher price with the available low fixed interest rate at the time. So I'm going to show you 9 of the worst bubble sells that I found on the Twitter account of TO Housing Spash. That's an account that speculates on the collapse of the Greater Toronto housing market and posts some of the worst seller losses on its account. 5 of these properties are inside the city and 4 of them are outside. There may be worse cases out there, and if you guys know of some, leave the addresses in the description, and if I get 5 or more properties, I'll do another video analysis. The findings were actually pretty interesting, and there's a twist with the absolute worst bubble cells that you're gonna wanna watch to the end to find out about. For this study, I'm gonna be using the historical discounted 5-year fixed interest rates that are available on RateHub, and the link to that is in the description below. And I'll also be using a modified version of my mortgage calculator tool, which I've made a video on here. Further, for simplicity's sake, I'm going to be assuming a 20% mortgage down payment for all purchases and a 30-year mortgage. But before I get into that, for those of you that don't know me, my name's Jonathan Lee, and I'm a real estate agent here in the city of Toronto. If you enjoy Toronto real estate content, please hit like and subscribe to catch all my latest videos. If you're looking to get a better understanding of what's going on out there in the Toronto real estate market, you can book a call with me through Calendly by clicking on the link below in the description. Now let's start with the smallest losses first. The first property we'll go through is Unit 314, 300 Manitoba Street, which is a loft in Etobicoke. This property sold in March of 2021 for $714,000, and at that time, a 5-year fixed rate mortgage was about 1.59%. With a 20% down payment, the monthly mortgage would be a hair under $2,000 at $1,996 per month. This property resold this January 2023 for $660,000, a loss of $54,000 or about 8% less than what it was purchased for in 2021. With the sales commissions and land transfer taxes spent on the property, the losses totaled about $112,000. A 5-year fixed rate mortgage is about 4.54% right now, which also happens to be the lowest mortgage rates available, and assuming 20% down on $660,000, the mortgage will be about $2,688 per month. So it would have been $692 less per month to buy in March of 2021 at $714,000 than it is in January 2023 at $660,000. The second property is 1741 Ada Crt, a detached 2-story in Pickering. This property sold in March of 2021 for $1,252,000, and the interest rate at the time would have been 1.59%, resulting in a monthly mortgage amounting to $3,501. This property resold in December 2022 for $1.14 million, a loss of $112,000 or about 9% less than what it was purchased for in 2021. With sales commissions and land transfer taxes, the losses totaled about $198,000. The December interest rate was about 4.54%, and assuming 20% down on $1.14 million, the monthly mortgage would be $4,643. So it would have been $1,142 less per month to buy in March of 2021 than it was in December 2022. The third property is 113 Baldwin St in downtown Toronto. This property sold in August of 2021 for $1.45 million. The interest rate would have been 1.68%, resulting in a monthly mortgage of $4,104. This property resold in January for $1.285 million, a loss of $165,000 or about 11% less. With the commissions and land transfer taxes, the seller's losses totaled about $288,000. Assuming 20% down on $1.285 million, the mortgage would be $5,233 per month, so it would have been $1,129 less per month to buy in August 2021 than it was this past January 2023. The fourth property is Unit 929 at 60 Heintzman St, a 1-bed condo in the Junction neighborhood in Toronto. This property sold in March of 2022 for $638,000 when the interest rate was 2.59%, resulting in a monthly mortgage of $2,041. This property resold this January 2023 for $555,000, a loss of $83,000 or about 13% less. With sales commissions and land transfer taxes, the seller's losses totaled about $132,000. Assuming 20% down on $555,000, the mortgage would be $2,260 per month. So it would have been $219 less per month to buy in August 2021 than it was in January 2023. The fifth property is 8 Jones Street, a detached house in Alliston, which sold in October 2021 for $1,186,000. The interest rate was 1.79% at the time, resulting in a monthly mortgage of $3,408. They resold in December 2023 for $882,000, a loss of $303,000 or about 26%. With sales commissions and land transfer taxes spent on the property, the seller's losses totaled about $373,000. Assuming 20% down on $882,000, the mortgage would be $3,594 per month. So it would have only been $186 or about 5% less per month to buy in October 2021 than it was in December 2022. So it looks like property values need to experience a market drop of more than 26% for it to be more affordable to buy today than it was when interest rates were low. Sixth property is Unit 307 at 120 Harrison Garden Boulevard, a one-bed condo in North York. This sold in March of 2022 for $800,000 when the interest rate was 2.59%, resulting in a monthly mortgage of $2,560 per month. They resold in November 2022 for $560,000, a whopping loss of $240,000 or about 30%. With commissions and land transfer taxes, the losses would have totaled about $297,000. Assuming 20% down on $560,000, the mortgage would be $2,321 per month, so it would have been $239 more per month to buy in March of 2022 than it was in November of 2022. The seventh property is 1390 Lawson Street in Innisfil. This sold in February 2022 for $1.7 million when the interest rate was 2.44%, resulting in a monthly mortgage of $5,331. They resold in November 2022 for $1.21 million, a loss of $490,000 or about 29%. With commissions and land transfer taxes spent on the property, the losses would have totaled about $588,000. Assuming 20% down on $1.21 million, the mortgage would be $5,015 per month, so it would have been $360 more per month to buy in February 2022 than it was in November 2022. The eighth property is 227 Windermere in Toronto. This sold in January 2022 for $2,165,000 when the interest rate was 2.34%, resulting in a monthly mortgage of $6,700. They resold in October 2022 for $1.7 million, a loss of $465,000 or about 27%. With commissions and land transfer taxes on the property, the losses would have totaled about $642,000. Assuming 20% down on $1.7 million, the mortgage would be $7,045 per month, so it would have been $345 less per month to buy in January 2022 than it was in October 2022. And the final property is 34 Fanning Trail in Brampton. This sold in January 2022 for $2.372 million when the interest rate was 2.34%, resulting in a monthly mortgage of $7,341 per month. They resold 1 year later in January 2023 for $1.765 million, a loss of $607,000 or about 26%. With commissions and land transfer taxes on the property, the losses would have totaled about $752,000. Assuming 20% down on the new purchase price of $1.765 million, the mortgage would be $7,315 per month, so it would have been $26 per month more to buy in January 2022 than it was in January 2023. Now, as I mentioned before, there's a twist with 4 of the last 5 homes, which are some of the worst bubble sales. And these are all the homes that were sold in Toronto for less than 75% of what they previously sold for. And the twist is that the first sales never closed. So the second time they were being sold, they were all being sold by the same seller that previously sold the property. For anyone that's not familiar with contract law and what happens if you don't close on a firm sale, the one who breached the sales contract, whether that's the buyer or seller, is liable for any losses the other party experienced. So assuming in each of these 4 cases it was a previous buyer that dropped the ball with a deal, the current seller can actually legally pursue that buyer for 25 to 30% of the loss of what the market did not pay, as long as they can prove that they didn't delay in a sale and resold for market value at the time. So that 25 to 30% loss that those 4 sellers experienced may not have actually been a full loss, because there's a good chance those sellers are going to legally pursue the first buyers for the difference. And if it goes to courts, it's pretty much open and shut. There's a number of recent successful court cases of sellers winning back hundreds of thousands of dollars in market losses from delinquent buyers. So based on this analysis, it looks like prices need to have dropped by 26% or more for it to be cheaper to buy a home today than it was 10 months to a year and a half ago. I think this has a lot of interesting implications. The obvious one is there aren't many neighborhoods that have dropped by this amount. But more importantly, I think this suggests the Toronto housing market is right now actually much stronger and more robust than we're giving it credit for. I mean, we're still in the wake of expecting a recession. We're still waiting to see how high interest rates will trickle down in our economy. And yet buyers are going out there making offers and are willing to put even more of their after-tax income into servicing Toronto housing. And that's crazy. So if we're still in a slow market dry spell, what do you guys think that suggests for future prices, particularly when rates drop again and buyers and sellers feel more confident about the market? Let me know what you think down below. So that's it for me. I hope you guys found this video entertaining. And for those who want to watch more, click on subscribe. It's free and you can waste more of your day watching me ramble on about Toronto real estate. Thanks for watching, and I'll catch you guys on the next one.